When examining the principles of fiduciary and breach of fiduciary responsibility, the crucial element is process. When courts look at whether somebody is a fiduciary or whether they have breached their fiduciary responsibility or not, what they'll look at is, was there a process developed and was that process followed? So let's take a look at some of the principles. The big problem with fiduciary responsibility, at least as far as the fiduciary is concerned, is liability. Liability is personal and impersonal. It's impersonal in that the courts don't care who's responsible, they'll get anybody, even Martha Stewart. It's personal in that fines and penalties are assessed and they have to be paid directly by the perpetrators. We've seen it in corporate fraud, we've seen it in securities fraud, and we're going to see it again. In GIW Industries versus Trevor Stewart, Burton, and Jacobson, a case from about 15 or 20 years ago, a money manager, Trevor Stewart, was liable for not inspecting the investment objectives of a fund. Now, Trevor Stewart was a good manager, a good New York money manager. They invested in bonds. In this case, Trevor Stewart invested 75% of GIW's portfolio in long-term government bonds. GIW knew of Trevor Stewart's investment philosophy, but they hired them with no restrictions. Well, no one at Trevor Stewart read the plan documents, knew the plan history, their cash needs, the demographics of their participants, and when Trevor was terminated, in a bad bond market, they'd lost over $700,000, but Trevor Stewart collected fees of $17,031.54. In the court case, the court said Trevor Stewart subjected GIW to too much market risk and liquidity risk and failed to diversify the investments. They were fined $537,000 and had to rebate their fees. The court then turned around and found the trustees jointly liable for allowing Trevor Stewart to violate the investment objectives. Well, guess who paid? No, it wasn't the trustees, it was Trevor Stewart because they had deeper pockets. There are 5 general standards of conduct which govern a fiduciary's duties with respect to dealing with somebody else's money. The duties must be done solely in the interest of participants and beneficiaries. Benefits have to be for the individuals, the plan participants, and everybody has a right to monitor the activities of the fiduciary and the investments.